Hi, I'm Murdoch, and thanks for listening to The Rate of Change with York Wealth Management. The Rate of Change is a podcast which explores the ever-shifting momentum of financial markets through the eyes of the leading managers in wealth management. In today's ROCast, I'm really excited to speak with Nick Thomson, the portfolio manager at Lakehouse Global Growth Fund. Lakehouse Capital is an Australian-based fund manager launched in 2016. They have a long-term investing approach targeting asymmetric outcomes via a high-conviction strategy in mid to large-cap growth companies outside of Australia. Based on January's fund fact sheet, the fund has averaged 13.6% for the past 5 years, saw the highs of 2021 with returns in the 30% region before experiencing a drawdown alongside most growth managers due to a rising rate environment. Recently, the fund's up 10.9% for the past month, while still being down 15% for the year. Today, we dive into some interesting topics which are at the forefront of most investors' minds, such as where they think the markets are going in this rising rate environment, how the fund is positioned to either defensively deal with the volatility and take advantage of this volatility, and we also cover specific holdings in the portfolio. I found the conversation on Google and Microsoft fascinating, specifically regarding ChatGPT. For a giggle, I asked ChatGPT via OpenAI to write a one-of-a-kind investment quote based on Lakehouse's investment approach in the style of Warren Buffett and Howard Marks. Successful investing requires a combination of rational analysis and emotional discipline. It's not about trying to predict the future, but about recognizing and valuing the opportunities that are present to you and having the patience and conviction to hold on to them for the long term. Quite remarkable, isn't it? So with that being said, I hope you enjoy our conversation with Nick as much as I did. So sit back and relax and enjoy it. Nick Thomson, welcome to The Rate of Change with York Wealth Management.
Good to see you, Murdoch. Great to be here.
Why don't we kick things off, and why don't you tell us a little bit about yourself and how you got into financial markets?
Yeah, sure. Look, I think for me, getting into finance was very much sort of a natural progression from early on. My father, he worked in the industry, so I was always around from a very early age. Even by high school, I kind of became fascinated with really trying to understand, what drives asset prices, aside from underlying fundamentals. It was pretty clear to me that there was also a significant sort of irrational and erratic nature to markets that was largely related to human psychology. That curiosity naturally led me to Sydney University, where I studied commerce. And then after that, I did an additional year where I did finance honours, and I was studying behavioural finance. In terms of my professional experience to date, prior to Lakehouse, the bulk of my experience was with Dakota Capital. They're an investment firm that focuses on private markets. So I was there for about 6 years, and we typically had more of a distressed lean there in terms of our investing style. So I actually joined that shop pretty early on, was employee number 4. Was also fortunate enough with them to actually get the opportunity to live and work over in New York towards the end of my time at Dakota, which was obviously a great experience. Fast forward to 2018, and I joined Lakehouse Capital. And ever since then, it's kind of been head down, bum up, very interesting markets, and I've been directly focused on the Global Growth Fund.
New York.
Something like that.
It's a good place to cut your teeth.
Very much so.
So let's talk about Lakehouse Capital Growth Fund. What is the philosophy of the fund?
Our approach is very much anchored around our philosophy, in that we are long-term, concentrated and seeking asymmetric setups. So that is, situations where we feel we have multiple ways to win and few ways to lose. In terms of, I guess, what makes us unique, I would say there are a few things, but I think the big one is really our focus. That really starts by being clear on where we don't want to invest. So we'll typically avoid commoditized, cyclical and capital-intensive industries. Think airlines, real estate, auto manufacturers, as the reality is, the bulk of companies in these industries just aren't good businesses. Their fortunes are often determined by a number of external factors that are beyond their control. And, over the course of the cycle, they tend to earn pretty poor returns on capital. So for us, as long-term investors with very much a long-term time horizon, it's a risk we're not really willing to take investing in those types of businesses. Instead for us, we focus on trying to find companies with one of three core economic models. And that's really centered around network effects, extremely loyal customers, and unique and enduring IP. We believe that these core economic models are the primary driver of, companies' resilience and durability, and over the long term, allow them to earn excess returns and compound shareholder capital. So that's why we have a deliberate focus on them. And this is what we refer to as our fascinations in-house. So I guess to give you a sense on one of them, extremely loyal customers, just so it's a bit clearer to you, because it can sometimes sound a little foreign. What we're really looking for there is, really companies that have products and services that are deeply embedded in either an individual's life or a business's process. So companies that are really kind of maniacally focused on, customer satisfaction and retention. Obviously, the more mission critical these products are, the deeper the lock-in, as there's pretty significant costs in terms of, operational risk and also time and money to change to a competitor. When you find these companies, they tend to be in a very powerful position, and there's a number of things they have, but the top three I'd say is very valuable recurring revenue streams, tend to have a significant degree of pricing power, and also are often underappreciated in terms of their ability to develop new solutions or cross and upsell. So I think we think that a number of the companies we have in our portfolio are almost akin to sort of modern day digital utilities in that sense. And really, I'm talking about our enterprise software holdings, our e-commerce positions, our payment processes, for example. So I guess that gives you a sense of the philosophy and, the type of companies we're after there.
Enduring IP. Give a bit of color around that.
Sure. So I guess on the IP front, what we're really looking for is, businesses that have intangible assets that essentially lead to pricing power but aren't captured on the balance sheet. So I think brands, patents come to mind. I think, the most obvious one for people to really relate to is consumer brands. So if you think about Hermes with their Birkin handbags, that will go for, anywhere from call it $20,000 to $60,000. The question you have to ask is, why is Hermes able to sell that Birkin handbag at extremely high gross margins and make a ton of money? Why are people willing to pay for that? And, in our view, it's the unique and enduring IP that they have and that they've built up over, more than a century in terms of building up that brand. I guess to really think about it from the consumer's perspective, it's, what does that do for the individual? And at the end of the day, it says, hey, look at me, I have a lot of money. And it turns out people will pay, a decent premium if they can have a product that kind of conveys that social status to other people. So that's kind of an example of something on the IP front.
So with the mandate of the fund, how's it structured?
We have a pretty broad mandate in terms of what we can invest in from a geographical and industry perspective. That said, we have typically and most likely will continue to be sort of skewed towards developed markets. We do have a bit of emerging market exposure, but that's typically around about 15 to 20% of the fund. But we are long only. So that is, we do not hedge, we do not short, we do not use derivatives or options or anything else there. It's purely long only. And as I said earlier on, high conviction concentrated approach. So we'll only ever have between 20 and 30 positions in the portfolio at any one time. And at the moment, we're kind of on the lower bound there, around about 2021. I guess the only other thing from an investor's perspective is maybe around liquidity. So the fund is not listed, but we do have daily liquidity, so a very liquid fund.
What's the size of the fund?
250 million.
Is that AUD or USD?
AUD.
And how can investors access direct? Is it on platform?
Yes, we are on platforms, and they can also come direct. So there's plenty of different ways to invest, but we do not have a LIC at the moment or anything like that. It's not listed.
Would you consider that? Or actually, here's a question, right? Because a lot of people want to know pros and cons between having a listed version of the fund compared to just having it private. Why has Lakehouse chosen the private path?
I think that is just the way we did it initially and the way the fund is, was set up. I think we've had discussions about possibly doing a LIC. I wouldn't say it's something that we won't do. It obviously has, some access benefits for investors, makes it much easier for them to trade just like another stock day to day. So I think we've thought about it. But to be honest, I don't think we've had a huge amount of inbound demand that has made us think that this is something super necessary we need to do. I mean, most investors are pretty happy with, direct access to the fund and also the platforms that we're on, like the NetWealth of the world and everything.
Is there an amount of money in the fund where essentially it reaches a cap and then the fund doesn't make sense? Or is it essentially an unlimited fund? You have the capacity to run billions or?
I think for the global fund, we're only 250 million in AUM. So one thing I will say to you with certainty is that capacity is not an issue for us. If we were sitting here having discussions around hitting our capacity limits, I would be a very happy man.
What is the capacity limit?
So look, we've got a small companies fund, which you would obviously you're familiar with. That's got a capacity limit around 400 to 500 million AUM, and that's really liquidity driven, right? There's just not you rule yourself out of certain opportunities, and it gets a bit harder to run the strategy. So we've made that sort of decision there. The fund is open at the moment, though. Look, there's a number of different ways you can calculate capacity. For us, we tend to be mid and large cap focused, so it's incredibly liquid. I mean, we're talking, it might be 10 plus billion before that would really become a concern for us if we were thinking about constraints or our ability to invest in the smaller end of the market.
How's the performance been with the fund?
Since inception,
Sure.
We've CAGR'd, I think it's roughly around 12% after fees, which compares to our benchmark of, need to check the latest exact numbers, but roughly around 8%. So I think there's about 4% of alpha there. So, in terms of what we're trying to do for investors, we're very happy with it. It's really generated decent, not just absolute, but relative returns to our benchmark. So we're quite happy. The fund is a little bit over 5 years old now, which is also pleasing. It's a decent track record. We get a little less questions about being very young, so we're pleased with that. Obviously, 2022 was a challenging year, though, as it was for many equity managers, especially long-only and growth-focused. But, thankfully, things have started to turn around the last few months. We've seen a few green shoots, and, we'll see what happens from here.
It's been a very interesting past 5 years.
That is true. I can tell you I've lived it.
Actually, this is a very good point regarding on those 5 years. A lot of people want to know as well as how do you manage the volatility in the portfolio? Do you have the capacity to go to cash? How much cash could you go to? Have you gone to? And essentially, how are you managing the volatility we're seeing?
A lot of people consider volatility risk. I would definitely argue against that and say, the volatility we see in markets day to day is more or less an opportunity. As long as you capitalize on it in the right way. So, risk for us is permanent impairment of capital. That's investing in a business where the fundamentals deteriorate or, the whole thesis goes south and we take a serious hit to our capital that we invested. Volatility, does not bother us so much. Obviously, for the end investor, they want to try and minimize that because it's never comfortable. But for us, it's really trying to take advantage of that volatility. And when we see what we consider, extremely high quality growth companies out there, true compounders that we'd really love to own, sometimes that volatility provides the opportunity for us to actually get established.
Any examples?
Yeah, there's plenty of examples. If you even go back and look at, and this is one thing I spend a bit of time on and I'm quite passionate about, but people think, if you look at the top 10 businesses in the world, people often wonder why you would ever invest in them. They kind of say, well, how can there be any edge or alpha investing in those companies? But even prior to the pandemic, if you looked at the top 10 companies and said, okay, how far do they swing from trough to peak in any given year? Most of them are moving 40 or 50%. And, that is just, they're crazy swings. And I can tell you that the underlying economic value of those businesses is not shifting as much. There's a lot of short-term trading, flows, narratives that really drives that. I think for us, right now, one of our larger positions is Amazon. We think it's one of the most attractive and dominant companies out there globally. They're the number one, cloud infrastructure provider and also e-commerce player globally, and, fast approaching one of the big boys in digital advertising as well. It's obviously been sold off on concerns around near-term profitability and some cost impacts that it's had on the back of the pandemic. But in our view, we think the growth potential 3 and 5 years out and where the business will be is still very much intact from an earnings power perspective. So it's very much a case of temporary issues providing, what we think is one of the highest quality businesses at a very attractive price. And that's, to be honest, one of our ideal situations to lean into. And that's why it's one of the largest positions at the moment.
So when money comes into the fund, say a new investor allocates via the fund or goes direct, what happens with that money? Does it on the day the money gets allocated and spread across the portfolio as soon as the capital comes in? Do you pull the capital and essentially wait for, I don't know, a pullback in a particular company which you like, then allocate? How's the process work?
Oh, I'll actually briefly touch on what was part of your previous question because I realised I just didn't answer it now after you've brought up cash again. But look, we've got a range of 5 to 15% indicative for our cash, but we can go above that up to 20 or slightly below 5 on the lower bound, depending on our conviction levels and how we're seeing the opportunity at any particular point in time. So that has been in flux over the years. When the market got incredibly hot in our view, our cash position naturally built up, and that wasn't us necessarily saying, hey, we're going to start building up cash because we think this is just getting unsustainable. It was more a factor of just finding it hard to try and find opportunities bottom up out there where the returns, stacked up and the math worked. Equally at the moment, we're very much on the lower end of that bound. So we're down around about 5%, and that's because we think, the opportunity is incredibly compelling at the moment. We're seeing plenty of companies and places to allocate capital. To your question around flows, they're not normally that significant on any given day. I mean, obviously we've got daily liquidity, so, flows are quite spread out, but, to the extent we get cash in, that just simply goes into our cash account. And, we won't be making a decision based on that. So if we got, unless it was an incredibly large chunk of money and we needed to because it was going to breach our, required range of that roughly 5 to 15 or 5 to 20%, we're not really forced to do anything because we got some new money in or anything like that. It's very much driven by the opportunity set and what we see in front of us.
Yeah, and the reason why I like understanding this because it touches on behavioral psychology, which is what you said you majored in, right?
Sure. So I'm a big believer that the markets are not rational. But
the markets are not rational. So with behavioral psychology, can you give a bit of give an understanding about how you're remunerated, how the fund's remunerated? So, and the reason why we ask this question is when money goes in, people want to understand what type of opportunities you're taking, what level of risk you're taking to hit your targets so you get more money in your pocket. But, how does that translate into the returns in the fund for the investors?
I mean, I think the first thing I'd just say around alignment starting out before we get into, performance fees and how we're remunerated, I think for myself, my personal investment in the Lakehouse Global Growth Fund is my biggest asset. And that includes anything from stocks to real estate, whatever. So I am very much personally, invested in the fund. I will eat my own cooking and live or die by those returns we will generate. Obviously, I believe we will do very well over the long term. So I'm happy to be there. But on the performance fee side, look, we earn a performance fee if we outperform the benchmark. So we have a 15% performance fee there. So it's very much a performance fee culture. At the end of the day, if we're not outperforming, that compensation is basically the bulk of our incentives. So we need to really perform to get paid at the end of the day. And I don't think anyone is really in this business to underperform, to be honest.
What's the benchmark?
So the benchmark is the MSCI All Country World Index in AUD terms, as the fund is in AUD as well. So look, we've historically done that well. One thing I will say is that we also have a high watermark, which we think is best practice. So at the moment, we're wouldn't surprise you that given the year we've had, we're significantly underwater, which means we need to get back to that level before we could ever capture fees again. So it's not on an absolute basis relative to the benchmark. We do have a high watermark.
The market's had a pretty big bounce since before Christmas, so they might have pushed it up a bit in your favour.
It's going in the right direction, but it's a long game. We've got some ground to catch up. So to be honest, anyone who invests here kind of gets a bit of a free kick on that. But, it's the way the fund's structured, and we think it's the best way to do it to ensure that we're aligned with our investors. We wouldn't feel comfortable if the markets had a drawdown and we were able to reset, essentially where we take performance fees. It wouldn't make much sense to us. So I think having the high watermark is the way to do it.
And with the fund itself, who owns the fund? Is there a Chinese wall?
Good question. So Lakehouse Capital is actually owned by the Motley Fool, who is the parent company in the US. But in terms of resources and work and everything like that, in terms of research, there is absolutely no crossover. So we do 100% of our own cooking. It's actually, the businesses are actually regulated in different jurisdictions. So we're actually, by law, not even allowed to talk stock. So it's quite strongly enforced. But no, we're very much the boutique here that you see is what we're running with. There's no other resources or anything like that or relationships.
So speaking of cooking, how do you actually cook the steak on a day-to-day basis?
Look, I guess in terms of what we're looking for out there, I kind of talked already to, the economic models that we're trying to find. And I think I kind of gave a bit of an intro there on that. But beyond that, what I would say is, there's a number of different attributes we're looking to invest with and also looking to avoid. So, as I said, we're looking for those asymmetric setups. So obviously, I guess I'll speak to the upside first, really what we like to see. One thing would be, gaining share of a growing market. It's obviously not the be-all and end-all, but all else equal. If you have a company that's gaining share within a growing market, tends to be that they're doing something right, that they have a unique value proposition that is really resonating with the market. Obviously, there are a number of other factors you need to think through in terms of, the industry structure, the rate of innovation in the industry, what are the economics associated with their growth, but it's definitely a positive marker we like to align ourselves with. One other thing we have a penchant for is founder-led businesses. You can look at a number of studies that show that founders tend to outperform, and that's no surprise. No founder, no business is really cared for like any other by its founder. And obviously, in most cases there, you have pretty strong alignment in terms of insider ownership. So not all our companies are founder-led, but when we like to, when we can get it, we like to have it, I guess. And then one last thing I'd just say is, pricing power, which is effectively a distillation of, a company's competitive position and the industry structure. So I think, by and large, when you find companies that have pricing power, the ability to push price increases onto the end customer without impairing demand, you typically have a high-quality business, especially from a competitive standpoint. And, that's something we think we have in spades across the portfolio, and it's definitely served us very well over the last few years in the higher inflationary environment. I guess just quickly on the downside, a few things we would avoid. Reliance on leverage, pretty self-explanatory, but really reduces the tail risks and also provides, I guess, more optionality to businesses, particularly in tough times like we're in now. If you don't have a constrained balance sheet, it can often allow you to go on the offense, particularly if your competitors are hurting. Another one would be concentrated customer bases or a reliance on someone else's business for a critical piece of infrastructure. So if you found a company that you thought had a great product, was doing really well, growing really fast, but for their distribution, they relied 95% on one partner. That's a key risk that, we're not really willing to take because it can obviously change overnight and have drastic impacts for the business. And then one other thing I'd just say is around cyclicality. Once again, just removing that tail risk. So that gives you a sense, I guess, of the elements we're looking for and looking to avoid in any typical investment.
Well, let's stay on the companies before we pivot into the wild world of macroeconomics. Can you give a couple of examples regarding companies that are currently in the portfolio that meet that criteria of what you're looking for and how they're performing?
I think a great example here would be Mercado Libre.
Mercado Libre.
So it is actually Actually, it may be, depending on the day, the largest position in the fund. So I think it's probably a good one to talk to. But, for
if
listeners...
anyone hasn't heard about Mercado Libre, I just have to bring this up because it's been in the papers quite a bit. So essentially, they had their largest competitor fall 80% in one day, I believe. And I believe it was due to a $3.88 billion accounting scandal.
Yes, you were referring to Americanas there. There were some issues they had on their supply chain financing or something of the like. But it basically looks like it was just internal human errors, or at least what they've said. But
you can't really plan for that occurring, can you?
You can't. And these things do happen. But look, I think how you really manage for that is the quality of management. And, Mercado Libre, I would say, being founder-led and also having that founder, very aligned through owning about 8% of the business kind of helps take away some of that risk that there's going to be that oversight. He's been doing this day in, day out for the last 23 years, building this business up from when it was a baby. And he has, a good $5 or so billion of equity on the line. I think it just, puts a different degree of oversight there in our minds. But yes, you're right. You can never completely rule it out. But a bit of an update there. Yeah, they've recently, I think it was on the 20th of January, formally filed for bankruptcy, Americanas. So obviously that's been a bit of a boon for Mercado Libre, given that they were one of the largest competitors in the Brazilian e-commerce space. So, a nice positive to have, but obviously we weren't planning for that one.
Have you looked into the numbers, like percentage-wise, how big an impact that's going to have positively for the company, for Mercado Libre?
Hard to know now, given they haven't reported. They actually report later this week. So we will get some fresh numbers, but we have seen some traffic share numbers and their traffic has spiked along with the decline in Americanas. So there's initial indications there that they've benefited pretty materially, as you would expect. But maybe just back on Mercado Libre quickly, and I might just run through in terms of the business. But yeah, like I said, I think it ticks a lot of the boxes for what we're looking for. And those that aren't familiar with the business, it's the leading e-commerce player in Latin America. But in addition to having, that core marketplace, they also have a number of ancillary businesses that strap on around that with advertising, payments and shipping. And importantly, in our view, not only do these, increase their market opportunity, but they're also pretty important in terms of increasing the stickiness of the platform to, consumers and merchants alike. So the business has been, incredibly successful to date and executed very well. To give you a sense, obviously they were a pandemic beneficiary, being an internet-first company. But between 2019 and today, so over the last 3 years roughly, they're 4.5x'd their revenue base. So growing at a very, very healthy clip. In terms of what we like about the business and the boxes it ticks, look, it's founder-led, it's gaining share of a growing market. It also has some very strong network dynamics at play, thanks to its marketplace and also its payments business, and also has a very long growth runway. And, that really comes from the fact that, not only is it still very early in Latin America in terms of overall penetration levels of e-commerce, but there's also a material percentage of the population that remain unbanked. So plenty of opportunity for them. I think one last thing I'd just touch on to kind of bring it home is really about valuation. I think, with the broad-based drawdown that we saw in 2022 across the market in general, obviously valuations have come back a lot, but that's been very acute with a lot of internet and growth businesses. And, our view would be that the baby's kind of been thrown out with the bathwater there. Doesn't really, your fundamentals haven't mattered too much, or your competitive position or whatever dynamics. And I think Mercado Libre is an example of that. It's trading at, despite continuing to execute very well and going from strength to strength, it's trading at about 5 times forward revenue, which is the cheapest it's basically been its entire history outside of the GFC. So a very compelling valuation, and we think the risk reward here is, incredibly attractive, and hence why we've got a very large position.
What are the big techs in the portfolio?
So we actually have a few names. So we have Amazon, and also Alphabet as some of our larger positions.
I think you also mentioned Microsoft as well.
Yes, Microsoft we added towards the midpoint of last year.
And let's discuss ChatGPT. I'm sure there's not a person that's listening to this has not heard about artificial intelligence pretty much taking over the headlines. I believe the statistics on it was it took 16 years for the World Wide Web to rack up 100 million users. And what was it? 100 million in 60 days or maybe even 30 days.
It might have been a month. I did see that stat flying around. Look, it's obviously...
That's incredible.
Ever since it's been released in the consumer model, it's had incredible success and I think blown a few minds with the responses everyone's seen online.
Can you give a bit of color around what is ChatGPT and essentially the impacts it has on these big tech companies? Some are discussing whether or not, like say Google with Bed, to use it to monetize it immediately, whilst Microsoft's gone down a different angle. And what are your thoughts?
ChatGPT is a large language model, what they call a LLM. So I'm sure you've heard that term thrown around and everyone's probably equally confused what they're even talking about with large language models. But, the actual definition is an artificial neural network, which they train on a vast data set to basically generate natural language responses to queries. So you've got a lot of data scientists and whatnot training these data sets such that, when you put in a certain query, you'll get something that comes back in a relatively, conversational tone. So, look, it's definitely taken the hype cycle by storm. Everyone seems to have forgotten about crypto and then the metaverse, and now we're on to large language models pretty quickly. So I think things are definitely, the hype cycle seems to be moving a little bit quicker these days, but there is clearly something beneath it in terms of the technology, obviously. I think where exactly that all goes, not many people know right now. I'm sure like chatbots and various business functions or work processes. The question is to what degree can they be automated and done better by a system like this? And I'm sure we'll see a lot more of it in the years to come. I think our direct focus right now is really, around ChatGPT and its ability or the potential that it could disrupt Google's core search business. Good question. I'm not as convinced as most people out there, but look, Microsoft held an event last week where they announced that they're going to incorporate an early version of ChatGPT into Bing, which is their search engine, and essentially run with that. That led to a pretty vicious share price response to Alphabet. I think the company lost, call it 100 billion or a bit over 100 billion in market cap just last week alone. So people are pretty nervous, and I think uncertainty is high, but I'd say their ability to disrupt search is probably being exaggerated to some degree at this point, not least because, Alphabet themselves is largely, regarded as a leader in AI, and he's been spending a ton of money and working on such technologies for an incredibly long period of time. So they would clearly have the technology there to roll something out similar themselves if they, wanted to. And indeed, I believe they will. They obviously already kind of are. They tried to do an event in response to Microsoft's last week, which wasn't exactly that convincing and had a few errors in it. And I think fumbling that response, they were clearly rushed, kind of led to, fed into the uncertainty around the business. But there's still a way to go in terms of the technology to get it to a point where it can disrupt search. And I say that for a few reasons, but, it's incredibly computationally intensive and expensive to incorporate a large language model like ChatGPT into search. I think the estimates I saw is roughly it's 8 to 10 times more expensive than a search query. There's also the fact that the data sets that you're running off are typically somewhat dated, so it's not giving you information of the day. It might be to the end of say 2022 or something, which obviously is not ideal as well. So there's a few constraints like that, and then obviously when you really step back and think from first principles, okay, well, what is Google's dominance in search really predicated upon or protected by? And I think a lot of it comes back to, the hardware and the operating system, advantage that they do have. Also the fact that, they largely have the brand equity and the consumer mindshare when it comes to search and arguably the best search product. So when you put all that together with their data advantage, it's not entirely clear to me how Microsoft's going to, disrupt that. I think one key stat is just 61% or a little over 60% of, search queries are actually done on mobile, where Microsoft has absolutely no presence. So unless they're willing to pay Apple the 15 to 20 billion a year that Alphabet pays for, the priority placement within the Safari browser, it's unclear to me how they're exactly going to steal that pot from Alphabet. So what I'm saying is there's a lot more to it than just a fancy technology and this is going to be so much better than search. Let's roll it out. I think, there's a lot more hype and it's a bit exaggerated right now in terms of the disruption risk to Alphabet.
Well, isn't that the biggest question? Like, what is it? What does it actually do? Is it like, the Colonel's secret recipe? Is that the code, or is it actually the thing that makes this thing so fascinating is the data set, as you mentioned before, that it can go through? So if, say, I'm using it right now to figure out which fund manager I'm going to use, right? Are you saying that the AI is only good as the data set which it can access, or is it the algorithm?
I think it's both. I think it's the data set that it can access and also how well it's been trained. So there's a few different variables here. I think the reality is we'll probably have numerous versions of ChatGPT like, products in the future with different companies, different companies offering them. But it's hard, right? I mean, even at the moment, there's instances where if it doesn't know the perfect answer, it will hallucinate and make things up. Now, that could be a bit of a problem if you really rely, if you think about Google search, it's a utility, right? Yeah. And what you want is speed, accuracy, and reliability. And that's why I just think, people are making a bit of a leap here to think that suddenly tomorrow, Microsoft, Bing, because it has.
Well, what's interesting about that is I've heard a couple of people that are, either portfolio managers, data engineers, or just anyone that requires a large data set. Some of them actually, just for a giggle, have had Google up and then had ChatGPT up, and they're asking the exact same questions. But what they're experiencing is via Google, you're getting the answer, but also 15 ads. Whilst ChatGPT, there's no ads and essentially refines and changes, or I could put up this podcast transcript and it'll remove all the ums, the ahs, and, maybe a comment I shouldn't have made quite cleanly, and it puts it up. And it can even rewrite the entire works of Shakespeare, in the language of Harry Potter. It's fascinating. But I suppose the question I'm asking, I'd really like to hear your thoughts on, is that's on the search component, but you also have a myriad of other companies out there. Does this artificial intelligence have the potential to improve the efficiencies of these businesses? Because what do you think? Is it purely a search engine, or does the individual who's doing their job now have a better source of information to fine-tune everything? And then do the companies internally become better? Like, as an example, in the States, in America, they banned kids and universities for using ChatGPT because kids were spitting out perfect 100% essays.
There's a lot of use cases, I think, that, when you really think through it, opens a lot of trapdoors and questions, even some moral and ethical ones, right? Like, can you ask, for instance, what information do you block? Which is obviously a decision Google has to make as well. But if you're asking ChatGPT something nefarious around how do I build a bomb or XYZ.
Elon Musk said that.
Yeah. So you get into a lot of, different areas. And I think over time that will all be worked out. But to your bigger point, I think this will, it'll end up permeating, not just the consumer's life in sort of whether it's search or whether it's even just a different use case of writing text or, different things like that, but definitely within businesses. I mean, call center functionality, I could see how this could easily, once you train the models and it's at a certain level and it continues to learn itself and compound, be way better than having human call centers, for example, right? So there's definitely big areas that I think it will change. Whether we're there yet with the technology, I don't know. But yes, obviously, my primary concern being the with my investor hat on is really around, what could this potentially do for or against any of our portfolio companies? And that's what we're kind of thinking about right now. But I think we'll continue to read widely, and there'll be a lot more that comes out around it. As for the narrative around this disrupting Google search, this isn't the first time we've seen such a narrative, right? We had it when there was vertical applications back in the day when people said, the TripAdvisors of the world are going to eat up search and search is going to decline. Didn't prove to be the case. Google just strapped on, various vertical search things onto its own platform. And also with Alexa, we're going to shift to voice and suddenly Google's not going to have a world. If you jump at that first sort of headline every time, you're going to find yourself, jumping out of all these incredibly dominant businesses very frequently, right? So I think it takes, it's worth taking a step back, deep breath, and actually thinking through, well, hang on, what does this technology do? What does it really mean? Is it really a search, purely a search functionality, and going through the elements. And I think when you do that, you realize that it's not as clear cut as maybe some headlines are suggesting.
Do you own any social media businesses in the company?
We do have a small holding in Facebook.
So here's a question, right? If the metaverse clearly didn't work, if Facebook pivots and essentially incorporates ChatGPT or the AI into essentially what they're doing, what does that do for the company?
Well, that's a good question. I mean, there's maybe, and that's kind of what I was getting at earlier, maybe a lot of businesses just incorporate this ChatGPT-like functionality into their websites or applications, and everyone's kind of running it. I mean, but at the end of the day, if you don't own anything that's proprietary or unique and it's all relatively like a commodity, then that's not going to be a great business, right?
Yeah.
So I think you've got to think through the barriers to entry and what it's really offering, and then who could really monetize that in a proprietary sense. And I have no idea at this point, but to your point exactly, I'm sure Facebook is Meta. Sorry.
From what you're saying, it sounds like it's more like a tool that will essentially improve the inner workings of these businesses, which I think is fascinating in comparison to something that could be quickly monetized.
I think so. I think on the consumer-facing side, it's hard to exactly see where it fits in. I mean, maybe you do go to google.com and you've got Google search, and then right on the right-hand side you have, Bard, which is, or whatever, their GPT, ChatGPT functionality as well. I'm sure you will see that.
Well, let's put a pin in this because I think we'll talk about this for the next hour because it's just mind-blowing because to your point, I don't think anyone knows where this is going, but what a fantastic...
fascinating space, I will say.
Space
it's going to change a lot of things, so it's definitely one to keep an eye on.
Let's talk about things that definitely change. Let's discuss China. It was the first one into the crash and appears it's potentially one of the first ones out of it. So I believe as long as I've known you, your favorite company in the entire world has probably been Tencent. So how is Tencent going and what's your opinion on what's happening in China now?
Yeah, sure. Look, we've been bullish on Tencent for a while. We think it is a fantastic business. One thing I will preface that with is obviously it's a mainland China stock, so it comes with other risks, right? So that's why it's never been a very large holding in the fund. But to your bigger point on China, yes, I think, what we saw in 2022 for them was almost the perfect storm. They had a pretty acute real estate slowdown, very significant regulatory crackdown, COVID lockdowns, round 2. It was really hard for it to get much more pessimistic for them. You had some incredibly cheap valuations over there. I think Tencent, if you stripped out their portfolio, you were talking a single-digit PE, and that was largely on what was, trough earnings as well. So since the country reopened, a couple of months ago, we've seen that kind of rip completely the other way. I think even businesses like Tencent, are, now up roughly 100% out of their October lows. So there's definitely been a bit of a shift there in sentiment. I think over the next, we're still comfortable with Tencent. It's a moderate holding in the portfolio, and I think China's probably in a good place to perform over the next, short to medium term. I think the longer term there, though, is definitely in my mind becoming more cloudy. And I just think the ongoing decoupling that you're seeing between the East and the West is certainly raising the geopolitical risk. So that's something we're thinking about a lot as to whether we really want to have that mainland exposure. Now we're very comfortable with it and we think it's a phenomenal business and will do well, but it's definitely something we're monitoring closely. Obviously, the other option is to get exposure to China through companies that are not listed there. We do have that as well, like an LVMH, which, the Chinese seem to have an insatiable appetite for luxury. And, LVMH has been a big beneficiary there. And that's obviously, that's also performed very well for the fund as well.
Thoughts on UK and Europe? Any exposure in the fund there?
We do have some exposure. So I just mentioned LVMH, and obviously a lot of our businesses are global, so they sell all around the world. But we also have Hemnet, which is a Swedish online property portal. So think of the REA. Basically, you can think of REA Group here without a competitor. So they're about 10 times the size of the next closest platform. So more or less, consumer-facing monopoly, great business. Very stable end market as well. So we very much like that. But our Europe and UK exposure at the moment is probably on the lighter side, and that is a deliberate decision. The inflation picture around the world is very different. The US is largely rolled over. Here, maybe we're about to roll over. China, no real inflationary problem at all at the moment. Europe, bit of a basket case. Obviously, they have the issues in the east, given the war with Russia and Ukraine, but also pretty significant energy crisis. So, inflation over there is taking a real toll, and it's a region that we've been underweight for a little bit now. Very, very wary about.
So I think I read a statistic that about 80% of central banks worldwide are currently in tightening phase. So what's your...
Certainly feels like it.
Certainly feels like it. So how's that impacting the fund? And I suppose, what are your thoughts on macroeconomics and where rates are going and the bigger picture?
I think on the macro front, look, we're by no means macro investors, that, very much business focused, bottom up, analysts looking for companies and focusing on the fundamentals. But what I would say with that is it's impossible to ignore the macro, particularly in today's world, right? We're always looking at it. We're definitely, if I had to kind of sense our macro or how we think about it, it's very much macro aware, but micro focused, right? So it does shape things we do, like I said, with Europe. But I think on the interest rate front, I think inflation is more or less yesterday's war. I think last year, central banks were going incredibly hard to tamp down on inflation and raise rates. And I think, in our view, we're probably closer to the back end of that, call it the 7th or 8th inning. I think you largely saw that with Powell's press conference recently. The market obviously reacted well. And whilst I would say he didn't say anything that was too optimistic, to be honest.
It was very, very nuanced.
What he did was he provided some certainty, I think. And really that's all the market or all investors really wanted to see, which was, just some certainty about where rates would end up and at least know that the rate of change, for lack of a better word there, better saying, I should say, was slowing down. And as soon as they saw that, it kind of, I guess, gave a lot of people who were sitting on the sidelines, there's plenty of capital out there just waiting for this to end, to lean in. So I think the inflation and interest rate picture is improving from here. I think the bigger risk as we look out over the next 12 months is really the recession risk. So, the question now is we've had this incredibly steep and quick ramp in interest rates. What's the demand destruction going to look like on the other side? And, to that point, I think it's incredibly hard to know because you have a lot of mixed signals. So, on one hand, you have the yield curve in the United States, which is basically the most inverted it's been the last 40 years, which is telling you in the next 12 to 18 months there is a seriously high probability of a meaningful recession. But then on the other hand, you look at the consumer data, the employment data, and it just continues to be incredibly strong. The fact that the last print we had for the US unemployment rate, 3.4, mid-threes, call it, percent, is the lowest unemployment's been since 1969, kind of tells you everything. Like the labour market over there is red hot. So I think, that's the real risk from here, thinking about the recession and just how sticky inflation proves to be on the downside, given wage inflation will probably, stay at least warmish on the other side.
I get this question all the time. So essentially, what does this rally? We've seen almost doubling from the lows, Tesla, a number of different tech companies, right? So is this do you think this is a bear market bounce, or do you think this is the beginning of a long, slowed recovery, or do you think trend is still down? Because we also, from the research we're currently receiving, there's also talks, as you said, with the inflation situation of potentially companies suffering a profit crisis, just as you said, the impact on discretionary spending, and then potentially if that occurs, we would hate to see it, but potentially a credit crisis of some sort down the end. Do you think that's where this is going, or do you think this is the beginning of the recovery, or what's your current opinion?
Yeah, I think on that, obviously the markets have had a really good start to the year. I don't think or I should say we at Lakehouse have much of an edge in terms of predicting recessions, credit crises, or anything like that. In fact, I would argue that, if you look back over history, no one really has a consistent edge there. And even if you do, trying to make money off it can be quite a tricky game. So, for us, it's all just bring it back to fundamentals. Like I said, despite all the doom and gloom, you're constantly getting headlines saying this or that is about to occur, the recession is coming, which, if you're betting on, that's fine, but it's also the most predicted recession of all time. But, for us, the portfolio companies continue to grow. I think over the last quarter, the weighted average, revenue growth across the portfolio is still north of 20%. So things are still very healthy from a fundamental perspective. So I'm not too sure where we go from here. We do have an inflation print this week, and there is an extreme amount of volatility out there. So things could change quickly. But, my personal sense is that, I think I'm starting to get much more constructive here from a risk perspective. And I say that for a few reasons, but, at least in the US, inflation appears to have peaked. And that's the most important market, given the Fed sets the cost of capital for the rest of the world. You've also got freight rates, commodity prices that are down significantly, which is a pretty good forward-looking indicator for where inflation's going. You've already got a 5% terminal Fed funds rate priced in versus 0% 18 months ago. So a lot of that dislocation we saw and that value adjustment has already played out. And then you already have, the NASDAQ down 25% and valuations at much more attractive levels than what they were. So I think right now, if you can focus on fundamentals and tune out the noise, and really, if you can take that 3 to 5 year view, I think, it'll prove a pretty good time to invest. I'm definitely more constructive right now.
So using that exact theory, what has been the most recent allocations to the portfolio? Which company?
Sure. So in terms of recent additions, we've added Hemnet, which I mentioned. We've also added Charles Schwab, which is one of the largest discount brokerages, turning into almost an asset management firm over in the States. And we've also added to a number of our higher conviction positions. So talking the Amazons of the world, CoStar, ServiceNow, Constellation Software, really a number of positions that we feel, have been sold off pretty, not irrationally, but just, sold off way more than they should have been. Fundamentals are holding up quite well. And for these businesses, we feel that whatever comes down the pike, they're pretty well placed to deal with it. And that's not just due to our philosophy, but, if you have, the world we're talking about right now, and it depends who you ask, but if we're looking at slower growth, maybe, moderating, but pretty persistent, higher inflation than we've had previously and higher interest rates, the question is, well, what kind of business do you want to invest in that environment? And we definitely feel we're in the right companies to deal with that. And I'd say, the things you want are secular growth, businesses that can continue growing, even if you get the broader economic weakness, high gross margins and pricing power, so you can deal with inflation. Definitely, maybe dominant businesses that are at least dominant within their markets. And I say that from the perspective of, not only are they best placed to, survive a recession if we get one, but the ability to play, I wouldn't underestimate the ability to play offense when everyone else is playing defense. If it is a very tough market and a lot of your competitors are reeling and you're able to reinvest and really try to capture the upside coming out of that, rapid market share gains can happen. And then the last one I'd just say is minimal leverage. Obviously, in a rising rate environment, it's obvious if your capital structure gets strained, you're going to come under pressure. So I think those are the four kind of key things, and I'd say it's pretty consistent not only with how our philosophy and strategy has always been, but we think we've positioned the portfolio accordingly, such that whatever plays out, hopefully our businesses will continue to thrive and grow for many years, and that will play out in share prices eventually over the long term.
So they're the themes that you're currently looking at. Is there any themes that aren't in the portfolio now that you're considering? A lot of the themes that many people are discussing, obviously, as you said, you're not going to touch airlines. So what about in the renewable space? You've got all the cars, the lithium batteries, solid state batteries starting to pop up everywhere. What about cybersecurity? Anything like this you're considering, or just not on your radar?
Look, I wouldn't say it's not on our radar. We'll look at anything. As I said, we're really searching from a bottom-up perspective, looking for those core economic models first, and the businesses that are set to benefit from those secular trends. So you noted a few there, cybersecurity. We've looked at it here and there. We don't own any direct plays there in terms of, pure cybersecurity companies, but there's obviously a huge opportunity there. I'd say, the rate of change in the industry for us is something we kind of struggle with. It does kind of move pretty quick. So it's hard for us to really feel like we have an edge in predicting how that's going to turn out. But we do have some exposure through the likes of Microsoft, for an example, which has, an absolutely massive cybersecurity business in and of its own right now. So we kind of get a bit of that without having to take the direct bet on any individual player. But it's very conceivable we could going forward. I mean, it's a very attractive market, and there's some businesses there, which I know you're familiar with, like the Cloudflares of the world and whatnot, that are very high quality, and there's some opportunities. So we'll always be looking.
Just to finish off, is there any thoughts you want to leave our listeners with?
Yeah, look, the only one thing I would say is that, and I was kind of touching on this earlier, is really just around the macro and uncertainty that's out there. Obviously, sentiment's incredibly depressed and there's a lot of fear. But I think at times like this, what really pays is to take a step back, deep breath, and focus on fundamentals. So if you can find those companies that you think are still performing very well, momentum is strong, their competitive position is strong, and you think they have great opportunity and potential over the next 3, 5, 10 years to continue growing, and they're trading at what is very attractive valuations today, I think it's a time to lean in. So I'm not suggesting that the bottom is in or I have any magical crystal ball, but when everyone is fearful is often the time, as Warren would say, that opportunity presents itself. So I just think now is not a time to put your head in the sand. Markets are forward looking. By the time all these storm clouds have dissipated and we're back here talking like it's the good old glory days, markets will be 30, 40, 50% off their lows, and we'll be back on the cycle. So
just like ChatGPT, nobody knows, but up it goes.
Good, nice one. You should trademark that.
If anyone wants to learn more about Lakehouse or the global strategy, how can they find you?
Lakehouse.com.au. We try to be pretty transparent in everything we do. So we publish a monthly letter. You can see our top 10 holdings there. We also talk about, the material holdings when they report each quarter. So definitely try to be, transparent with investors, and we've got quarterly webinars we run so they can find all that information there. And I think it gives you a pretty good sense of what we're about.
Thanks, Nick, for coming on The Rate of Change. It's been really enjoyable hearing your thoughts, and I hope you have a great day.
No problem. Thanks, Murdoch. It was a pleasure.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.